You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, "We're Not in 1999 Anymore," Toto, written on the 31st of December 2000. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. Hey everyone, ever been curious what it was like right smack in the middle of that dot-com bubble? You know, back when it felt like tech stocks were on a one-way trip to the moon. Well, today we're going to do a deep dive into that crazy time, but get this, through the eyes of Howard Marks. Now, this guy is an investing legend, and back in December 2000, right when the bubble went pop, he wrote this memo, an insightful one, and man, is it ever relevant today. So picture this. Marks compares that whole 1999 market frenzy to, get this, the land of Oz. Yeah, from the Wizard of Oz, like everyone's under a spell, right? He even calls it, wait for it, a sea of irrationality. I mean, seriously, can you imagine buying stocks based on practically nothing?
It's wild how Marx, he really saw those classic bubble size, that dot-com boom, fueled by irrational exuberance, as the economists call it. Basically, people were so hyped about the internet's potential that caution went out the window, valuing companies based on website hits, eyeballs, instead of, actual profits.
Oh man, remember those commercials from back then? So ridiculous, like that one with the mailroom guy, Stewart, bugging his boss to buy some random tech stock, shouting, "Let's light this candle," and the boss, all hesitant, "I don't know anything about this company." And Stewart just throws back, "Research it," as if that's the magic solution.
It really captures that blind optimism, doesn't it?
Right.
But by 2000, the mood, totally different. There's this other commercial Marx mentions. A dad's trying to invest for his kid's college. His son asks, "Dad, is a PE ratio of 23 good?" And the dad, totally stumped, suddenly realizing he has no clue what he's doing.
It's crazy how fast things flipped, right?
Yeah.
1999, the NASDAQ, record-breaking gain. Then 2000 hit, bam, biggest loss in its history, a 39% drop. And to really hammer home how dramatic this was, Marx points to 14 stocks from a previous memo. By the end of 2000, they were down an average of 82%. 8 of them, get this, lost 96% or more of their value.
Ouch. And that's the big takeaway. Markets can correct so fast, and if you're ignoring the fundamentals, you're in for a rough ride.
Man, I can't help but think about that website, dotcomfailures.com. Remember that? Like a graveyard of all those dot-com companies that went bust. Even the Super Bowl, the king of flashy ads, saw a huge drop in dot-com advertisers. The party was definitely over.
So why did it all happen? Marx breaks it down brilliantly in his memo. He points to things like low inflation, the rapid tech advancements, even government policies, all creating this environment of crazy confidence. And you know what that leads to? Excessive risk-taking.
And then, boom, reality sets in. Sales tanking, layoffs everywhere, and that risk aversion, basically fear flooding back into the market.
And that's where Marx's insight about the Russia long-term capital management crisis back in '98 comes in. Early warning sign, just because you take on more risks doesn't mean you'll automatically get those big returns. Always curveballs, unexpected stuff that can shake things up,
It's like he's saying, hey, the market doesn't play by the rules all the time, so don't assume it will. And this is where he starts laying out his investing principles, those tireless nuggets of wisdom, just as relevant today as they were back then. I'm ready to absorb some wisdom.
Well, the first one is all about avoiding generalizations. Marx argues the market swings from one extreme to the other. Just because tech's hot doesn't mean every tech company's a winner, right? And just because a sector's struggling doesn't mean every company in it's doomed. It's like trying to predict the weather based on one sunny day. You need a broader perspective.
So instead of these sweeping judgments, we need to, dig deeper. Evaluate each company on its own merits.
Exactly. Look beyond the hype or the doom and gloom. Focus on those fundamentals. What are the financials like? Who's running the show? What's the competition look like?
Makes you think, how often do we fall into that generalization trap, even in everyday life?
It's human nature, but we got to be mindful of it, especially with investing. Okay, so moving on. Marx's next principle, it's about respecting cycles. He reminds us nothing goes up forever. Like trees don't grow to the sky, right?
Like that saying, what goes up must come down. But how do we actually respect cycles? Without trying to time the market, which everyone says is impossible.
You're right. Trying to predict the exact peaks and valleys, that's a fool's game. But that doesn't mean ignore cycles altogether. Think of it like this. Understanding cycles exist and being prepared. It's like having an umbrella ready, even if you don't know exactly when it's going to rain.
I like that analogy. So how do we prepare for these inevitable market shifts?
Well, one way is diversification. Instead of putting all your eggs in one basket, spread those investments across different asset classes, industries, geographies. That way, if one part of your portfolio takes a hit, the others can cushion the blow.
So diversification is like a financial safety net.
Exactly. It's about managing risk, building a portfolio that can weather different market conditions. But diversification alone isn't enough. You also need a long-term perspective. Remember, market downturns, they're a natural part of the cycle. In fact, they can create some of the best buying opportunities if you're patient and disciplined.
This is making me think about all those times I panicked and sold investments at the worst possible moment.
We've all been there, but remember, investing, it's a marathon, not a sprint. If you've done your research, believe in the long-term prospects, stay the course.
Easier said than done sometimes. Okay, so we've talked generalizations, cycles. Now, what about those shiny new paradigms that always pop up? How do we tell the difference between a genuine game changer and just another fad?
That's where critical thinking comes in when you hear about a hot new trend. Don't just accept it, question it, challenge the assumptions, look for solid evidence.
And be wary of anyone promising the moon. Wow.
Exactly. Remember, no free lunch, especially in investing. If someone's guaranteeing huge returns with little to no risk, be very skeptical. There's always a catch.
So how does valuation fit into all this? It can feel so subjective, especially with new tech or growth companies.
You're right. Valuation, not always an exact science. But there are fundamental principles to guide you, for example. Look at historical valuations. How's this company been valued in the past? How does it compare to its peers? Any red flags or warning signs?
What about those situations where a company seems wildly overvalued, but the stock keeps going up?
Ah, yes. The classic bubble sign. As we learned from the dot-com era, bubbles. They burst. It might be tempting to ride that wave, but remember, the greater fool theory, it only works until it doesn't. And when it doesn't, consequences can be severe.
So how do we avoid getting caught in that frenzy, overpaying just because everyone else is?
One strategy is to set clear valuation limits ahead of time. Decide what you're willing to pay based on your own analysis and stick to it. Don't let that fear of missing out cloud your judgment.
This is making me think about how much psychology is involved in investing. How do we manage our own emotions, avoid those irrational decisions?
You've hit on one of the most challenging but essential aspects. The market, it's driven by fear and greed, and when those take over, bad decisions.
So how do we stay calm, rational, when everyone else is losing their heads?
Having a written investment plan, it can be a huge help, like a roadmap for your investing journey, outlining your goals, your risk tolerance, your investment strategy, even your exit strategy.
So like a personal rule book to keep us on track.
Exactly. And when the market gets turbulent, you refer back to your plan. Remind yourself of those long-term goals. Avoid impulsive decisions based on fear or greed.
It's like having a financial therapist on call.
I like that. Another helpful strategy, focus on what you can control. You can't control the market, but you can control your own behavior. You can choose to stay informed, be patient, disciplined, make rational decisions.
Okay, so we've covered avoiding generalizations, respecting cycles, being skeptical of new paradigms, how to value investments, even managing our own psychology. It's a lot to keep in mind. Is there anything else we should be thinking about?
Well, there's one more crucial aspect of Mark's philosophy we need to discuss. Defensive investing.
Defensive investing. That sounds a bit, well, boring.
Maybe, but essential for long-term success, it's about being prepared for the unexpected, worrying about what can go wrong, not just what can go right.
So, like a financial safety net, but for your whole portfolio.
Exactly. Diversification's a big part, as we discussed, but it also involves things like avoiding too much leverage, having a cash reserve, focusing on quality investments.
Hold on. Can you explain leverage again?
Sure, leverage is basically using borrowed money to amplify returns. Can be tempting, especially in a bull market, but remember, it amplifies losses too.
So, double-edged sword.
Exactly. When the market turns against you, leverage can magnify those losses, wipe you out. That's why Marx advocates for a more cautious approach.
Makes sense. What about that cash reserve you mentioned?
Having a cash reserve can be a lifesaver during downturns. Provides a cushion to absorb losses, and it lets you grab buying opportunities when others are forced to sell.
So it's like having dry powder ready to deploy when the time's right.
Precisely. And finally, defensive investing is about focusing on quality investments. This means companies with strong balance sheets, solid management teams, a history of profitability.
Sounds like defensive investing is all about minimizing your downside risk while still allowing for potential upside.
You got it. It's about playing the long game, protecting your capital, letting the power of compounding work its magic over time.
This has been such an insightful discussion. We've explored so many of Mark's brilliant ideas, but where do we go from here? How do we take all this wisdom and actually put it into practice?
That's the million-dollar question, right? It's one thing to get these principles, but actually using them in the real world, that's the real test.
So where do we even begin with that?
Well, first step's awareness. We got to be conscious of what's going on in the market, the rational and the crazy stuff. Got to recognize our own biases, those tendencies we have, and be ready for the unexpected.
It's like Mark says in his memo, the investor's chief problem, and even his worst enemy, is likely to be himself. We can really be our own worst enemies with investing, huh?
Exactly. So how do we overcome that? Marx is big on this, cultivating a contrarian mindset. When everyone's getting greedy, we got to ask, hold on, should I be cautious here? And when everyone's panicking, got to ask, is this actually an opportunity?
It's about thinking for ourselves, not getting swept up in that herd mentality, right?
Precisely. And it's not just being contrarian to be different. It's about being skeptical, questioning assumptions, wanting evidence, like a detective, always looking for clues.
Oh, I like that, like piecing together a puzzle.
Right. And remember, humility's key here. We can't predict the future, not perfectly. There will always be surprises, things we just couldn't have seen coming.
That's why Marx is so big on having a margin of safety, right? Not overpaying for investments, even if we're super excited about them.
Exactly. It's acknowledging we don't know everything, building in that buffer to protect us from those inevitable surprises.
So it sounds like this defensive investing, being ready for those worst-case scenarios, that's really at the heart of Marx's whole philosophy.
It is. He's not saying avoid risk completely, no. He believes taking risks intelligently, that's essential for returns, but the emphasis is on managing risk smartly, protect your downside while still having that upside potential.
Not being a pessimist, but a realist.
Right, exactly. It's knowing what you can control and what you can't. We can't control the market, but we can control how we behave. We can choose to be patient, disciplined, rational.
It's like that quote Marx uses from Warren Buffett: the less prudence with which others conduct their affairs, the greater prudence with which we should conduct our own affairs.
Such a good reminder. When everyone else is being reckless, that's when we need to be extra careful ourselves.
This has been an amazing deep dive. Marx's memo is packed with wisdom, and it's incredible how relevant it still is, even though he wrote it over 2 decades ago.
It shows how powerful those fundamental principles are. Human nature doesn't really change, and neither do those basic market dynamics.
So for our listeners who want to actually use these principles, where should they start?
Well, I'd say read Marx's memo for yourself. Links in the show notes. As you read, pay attention to what really clicks for you, what challenges your thinking, what makes you curious,
And don't just read it passively. Really engage with it, highlight stuff, take notes. Ask yourself, how can I use this in my own investing? Or even just decision-making in general.
It's a journey, not a destination. And the more we learn, the more we realize how much we don't know.
That's the exciting part. There's always something new to discover, always room to grow.
Exactly. And remember, investing isn't just about making money. It's about understanding the world, managing risk, making informed choices. It's about being part of that whole grand symphony of the markets.
Beautifully said. Well, folks, that wraps up our deep dive into Howard Marks and the lessons of the tech bubble. Hope you found it insightful, got you thinking, maybe even a little bit inspired. Until next time, keep learning, keep exploring, and keep diving deep.
It's about avoiding those losers, letting those winners take care of themselves.
Man, that's powerful stuff.
Yeah.
It's like, focus your energy on not messing up, and the good stuff will follow naturally.
It's a shift in perspective, right? Instead of chasing those home runs, you're playing solid defense.
Makes you wonder, could we apply that to other areas of life too, not just investing?
Definitely. It's about recognizing that sometimes the best action is inaction. Knowing when to hold back, when to say no, when to just let things play out.
It's like that old saying, don't just do something, stand there.
Exactly. And that takes discipline, patience, a willingness to go against the crowd sometimes.
So to wrap things up here, what's the key takeaway for our listeners from all this?
I'd say it's this. Remember, Marx wrote all this back in 2000, but it's shockingly relevant today. Markets are cyclical, those patterns they repeat, and understanding those cycles, human psychology, that's timeless wisdom, applies no matter what the market's doing.
It's like the more things change, the more they stay the same, right?
Right, so the question for all of us is, how can you apply Mark's wisdom to your own investing or even just your decision-making in general?
Really gets you thinking, doesn't it? Well, folks, that's a wrap on our deep dive into Howard Marks and the lessons of that tech bubble. Hope you found it as fascinating as we did, gives you some food for thought. If you're hungry for more, go check out Mark's full memo. We've got the link in the show notes. Until next time, keep learning, keep exploring, and keep diving deep.